Do you work at Google, Amazon, Microsoft, Meta, or another multinational company? If you hold company shares overseas and recently moved back to India, a simple reporting mistake could potentially expose you to significant penalties, even if you never sold a single share. Welcome to This Explainer. Today, we're unpacking a massive financial blind spot that's currently catching out thousands of honest tech professionals who've relocated back home. It's a single, seemingly minor tax oversight that can trigger life-changing penalties. Okay, let's dive right into this. So, let me ask you, do you currently hold overseas company shares or restricted stock units from your time abroad? Because if you do, and you're back in India, you really need to pay close attention. A lot of folks assume they're totally compliant, but a simple reporting mistake on your tax return could expose you to severe financial and legal consequences. And the craziest part? This applies even if you have literally never sold a single share. The stakes here are incredibly high. We're talking about a 10 lakh rupee penalty. And that's a flat, non-discretionary penalty you could be facing per year. This isn't just a tiny slap on the wrist under some standard tax code. This is actively enforced under India's stringent Black Money Act. Just let that sink in for a second. A 10 lakh rupee penalty per year, per asset, even if the actual monetary value of your shares is basically negligible.
Section 1. The hidden trap.
There's this fundamental cognitive trap that catches so many of us out. See, most people naturally think taxes only matter when money actually hits their bank account, specifically when shares are sold. That's the paying tax side of things. But reporting assets? That is a completely different legal concept. Under Indian law, simply holding a foreign asset, like a US-listed company share, triggers a strict mandatory legal obligation to report it every single year. Paying tax is about income, right? But reporting assets is all about transparency. Mixing these two concepts up is exactly where the trouble begins. Section 2. Understanding RSUs and ESOPs. To really understand where this legal trap snaps shut, we need to look at how this compensation works. A restricted stock unit, or RSU, actually isn't a share of stock when it's first handed to you. It's really just a promise from your company to deliver a share at some point in the future, usually provided you meet certain conditions, like, staying with the company for a few years. It's a conditional entitlement. You don't actually own the foreign asset on day one. So the absolutely crucial point here is understanding this life cycle timeline. First, you have the grant. That's the promise we just talked about. No tax or reporting needed there. Then comes vesting. This is that magic moment where the promise finally turns into actual shares deposited into your foreign brokerage account. At vesting, it's treated as salary income, and your employer usually deducts tax at source, TDS. But here is the trap. Phase 3, the holding phase. Even if you never sell those shares and they just sit there gathering digital dust, you are now actively holding a foreign equity asset. This is exactly where that mandatory reporting obligation kicks in. Finally, phase 4 is the sale, which triggers your capital gains tax. But whatever you do not ignore phase 3. Section 3, what is Schedule FA? Enter Schedule FA, which stands for Foreign Assets. This is a mandatory disclosure section tucked away inside the Indian income tax return forms, specifically ITR-2 and ITR-3. You literally cannot use the simpler ITR-1 form if you have foreign assets. Schedule FA is basically the government's way of trucking global wealth. It covers everything. Foreign bank accounts, real estate, global stocks, your uncashed US 401k, and yes, for sure, your company RSUs sitting in a brokerage account like Charles Schwab or E-Trade. But who actually needs to file this thing? First and foremost, this applies to taxpayers classified as Resident and Ordinarily Resident, or ROR. Basically, if you've been back in India for a couple of years, you're very likely ROR. Second, and this catches literally everyone out, Schedule FA operates on the calendar year, January 1st to December 31st, not the typical Indian April to March financial year. Third, it's triggered by mere ownership. Even if the asset earned zero income, or hey, even if it's a dormant bank account from your grad school days with like $5 in it, you must report it. No exceptions. Section 4. Let's look at a real example. Let's ground this in a really common scenario. Imagine a Google employee. They worked in the US for a few years, did great, and received a grant of RSUs. Fast forward, they move back to India. Those RSUs vest, turning into actual Alphabet shares. But our employee decides to just hold on to them, letting them sit totally unsold in their US brokerage account. The critical question here, should those unsold holdings be reviewed for Schedule FA reporting? The answer is a massive, resounding yes. A lot of employees think, hey, my Indian employer already deducted TDS when the share is vested, so I'm good to go, right? Wrong. The TDS covers your income tax liability on the salary part. It does absolutely nothing to fulfill your personal, separate legal obligation to disclose the foreign asset under the Black Money Act. They are two completely different compliance tracks. Section 5. Potential consequences. And guys, we aren't just talking in theory here. Listen to this direct quote from a real ruling by the Income Tax Appellate Tribunal in Mumbai. They stated loud and clear that if foreign assets are not reported in Schedule FA, the taxpayer is liable for a penalty of 10 lakh rupees under Section 43 of the Black Money Act. The tax department is actively receiving automated financial data from the U.S. and other countries under global treaties like FATCA and the Common Reporting Standard. They already know about your shares. Schedule FA is just your one chance to declare them before they come knocking on your door. Let's anchor this number in your mind one more time. 10 lakh rupees. And honestly, here's the absolute scariest part about this provision. This penalty applies per year of default. If you casually missed reporting for 3 years because you didn't know, that could potentially mean a 30 lakh rupee penalty. And it applies totally regardless of the asset's value. A $10,000 RSU account carries the exact same penalty risk as a $5 million overseas mansion.
Section 6. Your compliance checklist.
Okay, here is your actionable 5-point checklist. First, verify your residential status. If you're classified as ROR, you must file. Second, remember to look at your statements from January to December, not April to March. Third, and this is a bit of a puzzle, you actually need 2 entries. You must report the foreign custodial brokerage account itself in Table A2 of the tax form. Fourth, you must report the actual vested shares inside that account in Table A3. And fifth, when you're reporting the values, you have to convert those US dollars to Indian rupees using the State Bank of India Telegraphic Transfer Buying Rate, the TTBR, for the specific dates required.
So what does this all mean for you? If you've worked abroad or hold foreign company stock, please review your reporting obligations carefully before filing your return. A reporting requirement doesn't always mean additional tax, but ignoring it, that can become incredibly expensive. Don't let a simple paperwork oversight cost you your hard-earned wealth. Follow for more practical tax insights for NRIs, founders, and global professionals. Stay compliant and see you next time.